asked Ben Bernanke whether he thinks that with transparency and the forward guidance that effectively comes with that, if it locks in the Fed, for example, the most recent case of the 50 basis point rate hike.
There's no strategy that doesn't have occasional downsides. I think the clearest case in the most recent period is that the Fed said they weren't going to begin to raise rates until certain criteria were met, first of all. Secondly, until they had QE had gotten to a certain point and they were going to taper first, et cetera, et cetera. So the forward guidance, I think, overall, on the margin, slowed the response of the Fed to the inflation problem last year to some extent.
So does that mean it was a mistake?
Well, they had different. So this is a complicated question. The question is, why did they delay that? I think that why did they delay their response? I think in retrospect, yes, it was a mistake, and I think they agree it was a mistake. There were a number of reasons for it. One of the reasons was that they wanted not to shock the market. They wanted to avoid. Jay Powell was on my board during the taper tantrum in 2013, which was a very unpleasant experience. He wanted to avoid that kind of thing by giving people as much warning as possible. Right. And so that gradualism was one of several reasons why the Fed didn't respond more quickly to the inflationary pressure in the middle of 2021. There were other reasons as well.
What do you think?
Well, one of them was that in early 2021, after the American Rescue Plan was passed, and this was something like $2.8 trillion in new federal spending between the American Rescue Plan and the December program. The Fed could have responded at that point, but they looked around and said, well, look, there's still a lot of slack because the unemployment rate was still close to 6%. The number of people working was still well below where it was before the pandemic. And so they said that, well, there's still a lot of slack in the economy. We should let this fiscal program do its job and bring the economy back to full employment. What we've learned since then is that because of the pandemic, with a lot of people staying home, that the unemployment rate, for example, the number of jobs may not be a really good indicator of whether the labor market is hot or not. And so they're looking now at things like the number of job vacancies, which show that employers are having a terrible time finding enough workers and that the labor market is distorted. The other issue that they were looking at was the supply chain issue. You know, the pandemic has snarled supply chains around the world. That has helped drive up prices. The Fed believed in the middle of 2021 that these factors would likely solve themselves over time. That, in other words, that the supply shocks were, quote, transitory, and so that they didn't need to respond to the early stages of inflation because it was going to go away by itself. That proved wrong. So there were a couple of issues, I think, that are related primarily to the pandemic itself and the way that it scrambled the usual indicators that made it harder for the Fed to read the economy.
We then got into a question about how he read the economy at that time.
I wasn't particularly on board with the view that the number of jobs was the right indicator of how tight the labor market was, because I knew, first of all, that immigration was low. I knew that a lot of people were staying home not because they couldn't find a job, but because with pandemic and Delta variant and so on raging, they weren't looking for a job. But I did believe that some of the inflation was coming from factors created by the pandemic, including the supply chain problems, the reduction in labor supply, the fact that people were shifting their demand away from services like restaurants towards durable goods like cars, and that was putting up the prices tremendously in those durable goods. So we've seen big increases in car prices, for example. So I thought, I don't know, I didn't have a specific time frame in mind, but I thought that over this year that those things would begin to reverse. I still think they will reverse eventually, but clearly they've been more persistent, more problematic than the FOMC had thought.
And over the years, former Fed Chair Ben Bernanke has written a lot about inequality. I asked him about the debate over a wealth tax.
I'm not against taxing billionaires, but I think a better way to do it would be to raise capital gains taxes. You could tax realized capital gains. I think an important thing that would be helpful would be to eliminate the provision that when you pass appreciated securities onto your heirs, the appreciation is not taxed at any time. So there are ways to increase the tax burden on both the income and the wealth of rich people, which I think are much more, just more practical than a straight wealth tax. And I know defenders of the wealth tax would disagree, and there's a great debate about that. But I don't disagree with the objective, but I think that you just need to find a method that will, not be impossible to enforce.